Good morning, everyone. My name is John D'Antona, and I'm the Director of Marketing here at CAPIS. Welcome to our monthly research call. CAPIS would like to thank all of you for taking the time out of your busy day to spend with us. We hope you find the following information in today's call useful. In order for us to serve you better, there is going to be a brief survey at the conclusion of the call that we'd appreciate you taking just a few minutes of your time to fill out. And with that, we say thank you to the people that put it together. But before we get started, as always, the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and/or information presented within the presentation are for the sole use of institutional investors. Nothing in this presentation should be construed as an offer, invitation or recommendation to sell, or solicitation of an offer to buy any securities that might be mentioned. And now, on with the call. I'd like to turn it over to Nick Colas, but before I do, please note that Nick will be taking questions at the conclusion of his remarks. Please kindly type them into the Q&A portion of your Zoom, and I will be sure to get to them. And again, there's that brief survey at the end of the presentation. So just take a couple minutes and fill it out for us. Helps us serve you better. Nick Colas is one of the two founders of DataTrek's, a research consultancy focusing on market fundamentals designed to make the investment process more profitable, robust, and efficient. Colas is a 30-plus year veteran of Wall Street with experience in equity research, money management, and investment banking. From 1991 to 1999, he was the senior equity analyst at First Boston, now Credit Suisse. From 1999 to 2001, he was an analyst and portfolio manager at SAC Capital, reporting directly to company founder Steve Cohen. Most recently, Colas was director of research and chief market strategist for first Rochdale Securities and then ConvergeX Group. Nick, as always, welcome.
Oh, thanks very much. And let me add my thanks to having everybody on the call today. Hope it is a productive use of your time. For the topics this time around, the CAPIS team provided several ideas of what they wanted to hear about. And so we're going to focus on those questions today and give you both the questions and then our perspective on an answer. And we'll do it in the form of both looking at the data behind the question and then some of the market narratives around the questions. The questions are quite broad in scope, which is great. So hopefully, as we go through these, you'll get a sense of how we look at the world and are certainly free to ask questions at the end as to refining any of the comments that we have today. I'll go through the first four questions. Jessica's got the last one. So let's go start with the process. What is the long-term impact of younger investors on equity prices? That was the first question, and frankly, the most detailed question from the CAPIS team, because they point out that younger investors seem to have different priorities, things like ESG investing or thematic investing, like legal marijuana stock investing, things like that. They also don't seem to focus on traditional fundamentals anywhere near as much as, say, my generation of investors who came along in the 90s and 2000s. They seem to look at different things. And lastly, they seem to have at least some disdain for traditional finance. There seems to be some real glee in, for example, squeezing shorts in various names. And we've seen that play through in the last 12 months in several high-profile names. So that's the basics of the question. Are younger investors really all that different? And what does it mean to capital markets over the long term? And let me just start with a little bit of basic data because it's important to understand the scale of this question. The single most important soundbite, I think, it was in the Robinhood S1, which showed that they have 18 million funded accounts right now in their system, up from basically 0 3 years ago. So there has been tremendous growth in retail investor interest in the stock market and actual trading and investing over the last 3 years. Much of that came in the last 18 months. And the proxy we use for that is looking at how many Google searches there are in the US for terms like invest and buy stocks. And it shows very clearly that this wave of new investors really started in March of 2020 with the big market downdraft. And it really peaked in January of 2021 with the pullback in January and the last round of stimulus checks. However, and this is super important, the interest in investing and buying stocks and stock trading, at least according to Google Trends, is now right back to where it was at the start of 2020. So as much as we had an initial wave in March of last year and a big follow-on wave in February or January of this year, that trend's basically over. So we do have a lot of new investors, but I would put it this way, there's not a lot of new investors in US equities right now. Folks have funded their accounts, they're trading, but we're not seeing that big wave of new interest that we had over the course of the past 18 months. Another way we look at this data and look at this question is I literally go on every day on Fidelity, which if you're a retail account at Fidelity, you can see the 25 most traded names on the platform every single day. And it shows you how many buys and how many sells there are. And looking at that every day, it's clear that the most common style of the way this group tends to trade is simply buying a discounted opening in a single stock and then selling it towards the close, because the buy-in balances are quite high at the beginning of the day, and then they square off by the close. Very common strategy for trading in a rising market. And personally, I don't see it as being as disruptive at a macro level as perhaps some of the micro level analysis that people do on things like GameStop or AMC or other meme stocks, where the effect has been profound. At a broader level, this cohort seems to trade very much like I traded at SAC. You find stocks to buy at the open and you sell them by the close. It's not as dramatically different as I think some people think. Also, I would note that options trading has been one area where this cohort has become more aggressive, but even that's beginning to trail off. Options volume at retail are definitely declining in the month of September after having a very strong growth for most of this year. The upshot, at least in my mind, is that retail is obviously a growing force in investing, a growing force in trading, but it's no longer a growing force. The folks who funded accounts, they're trading, they're investing, they're doing so along some unique lines, yes, but they're doing it, broadly speaking, to make some money every day and to basically trade very similar to how an old school day trader used to trade. For good or for bad, that's the way they look at the world. Now, the bigger question we want to address is how different is the young retail mindset? How different are these retail traders? And a couple of points. They are different, I think, in three ways. The first is that ESG is very much more important to this cohort than prior iterations of investors. And that's why asset managers like BlackRock are so focused on building ESG products. ESG is important to this cohort. They've been raised with it, they believe in it, and they want to see their investments go to some social good on top of making money. It doesn't mean they don't want to make money, but ESG is clearly more important. Second way they're different is that, yes, they do back companies they either understand or think they understand or really believe in perhaps a little bit more than prior generations, but we'll discuss in a second why it might not be so different. And then lastly, and perhaps most importantly for much of this audience, the new batch of retail investors clearly believes trading should be free or low cost, and financial services should work like everything else in their lives. Tech-enabled, app-enabled, real-time, low or no cost. And that's different from, I think, prior iterations of investors who did understand that a broker has to have a commission, that it costs money to invest. And that's a big sea change, I think, in terms of how younger investors view the world. Now, a couple of reasons why they're not so different, or if they are different, why they're different for the right reasons. Let's not forget, and I've been doing this since 1984, that, fan capitalism, buying stocks and things that you like because you like the CEO or you like the story, is absolutely nothing new. And it hasn't always worked. I mean, look at buying Jack Welch's GE in the 1980s and 90s. That worked until Jack left, and then it hasn't worked since. Think about Enron or Sunbeam. Every investor cohort is susceptible to story stocks. This cohort, the new cohort, is really nothing different. Every investor class, every investor demographic cohort makes mistakes. And our generation, my generation, was just as susceptible to mistakes as this generation is, and everybody learns from those mistakes. The second way that they are perhaps not so different, or at least maybe even a little bit smarter, is because think about where investing was 30 years ago in the 1980s and 90s. Mutual funds carried 5 to 8% loads, back-end loads, 12 / 1 B 1 12 / 1 B 1 fees, 200, 300 basis points, and people happily paid them. 30 years ago, 40 years ago, 50 years ago, 60 years ago, 70 years ago, 80 years ago, 90 years ago, 100 years ago, 200 years ago, 300 basis points, and people happily paid them. And as they became more experienced, they realized index funds were a better approach. But again, it's not like the baby boomer generation got it all correct in the 80s and 90s. We paid some astronomical fees to get involved in the markets, which this cohort, the new cohort, does not. But perhaps the most important thing to understand about why this cohort is different than perhaps the 80s and 90s cohort, the baby boom generation, is think about where the S&P traded through the 80s and 90s. The compounded annual return of the S&P through 1999 for the prior 20 years was 18%. You doubled your money every 3.5 years for 20 years. And so there was a natural level of optimism and interest in the market, and perhaps not caring so much about when you buy, but buy and hold worked. But in the last 20 years, ending 2020, the compounded annual return of the S&P has just been 7%, so less than half of the 80s and 90s. And that's why I think the younger investors are so interested in buying the dip, in buying crashes the way they did last year, in buying distressed names, because they view their path to success in the stock market as not buy and hold, but trading oriented, and specifically buying anything that drops a lot. And yes, sometimes there'll be a mistake, but you got to understand where they're coming from. They're coming from a perspective where they've seen 2 major, now 3 major stock market crashes since 2000. And they understand that you got to buy low and sell high. And it's a very different mentality from the one that I certainly was raised with in this business, and perhaps a lot of you were as well. So the bottom line to this discussion is, yes, retail investors are different, but they're different for some very valid reasons. They're different because of the way they were raised. They're different because of the experience they've had in the market. And it's a broader discussion than just why are they so dumb as to buy GameStop or AMC? It's a broader discussion. And I think in many ways, I think once you sort of broaden the discussion, it makes more sense. So that's our perspective on the first question. Question number 2. What is the impact of supply chain constraints, especially going into holiday 2021? So let's just briefly discuss why there are even supply chain constraints in the system right now. And this applies to everything from a new car to a sofa you want built and delivered to electronic goods. It really is broad. And the issue is this: there was a very sharp recession last year, but it was very short, because of stimulus checks in the US, because of a lot of monetary stimulus around the world. And we had a very quick improvement in unemployment. It was a very atypical recession. Recessions typically take a couple of years to unwind. This one was basically done and dusted in 12 months. We still have some residuals to deal with, but it was very fast. The wealth effect from the stock market also helped a lot. And we had a really unprecedented mass migration of Americans out of cities into suburbs, which created a lot of demand, not just for houses, which we continue to see are in short supply, but also for a lot of household durable goods, appliances, furniture. You go from an apartment in New York that's 1,000 square feet to a 3,000 square foot house in a suburb, you're going to buy a lot of new stuff. And that surge in demand has hurt, and it's created a lot of the supply side of the supply chain imbalance. We've also had production issues. China has a zero COVID policy, which means that if somebody in a factory or at a port is test positive for COVID, they shut down that person's entire wing, division, operation until they can clear the system to make sure that nobody else has gotten it. That's created a lot of supply disruptions. And then obviously we've had a lot of such disruptions in chip shortages, because those are very complex products to build. And you basically have to tool a production line for either the chips for a car or the chips for an iPad or the chips for an iPhone, and you can't switch freely between them. And so a lot of those factories switched over to making products for electronic goods because demand there was good last year, and never caught up on the supply side for the automotive, which is why we still have automotive supply shortages to this day. The 2 effects of the supply chain shortage that we think are important are, first, lack of supply in some critical areas. And I would point to used and new cars. I was an auto analyst for a decade at First Boston, as John mentioned. And so I know that industry very well. And it's going to be a persistent issue, not just because the chip shortage is persistent, but also because car companies traditionally are not very profitable. And so they're seeing the current supply chain shortages as a chance to raise price. And they'll continue to raise price because they need the profitability to fund things like electric vehicles, autonomous vehicles, and the shift to those technologies. So that is an area where inflation is going to be persistent and long lasting. And you're going to see it across the board in small cars and luxury cars, really everywhere. So it has some parochial effects on certain industries, but it isn't necessarily a broader scale issue. There is actually one positive to it, because if you have supply chain disruptions that limit supply and therefore limit consumption, in theory, your economic cycle can be longer because consumption is deferred to future periods. And so that does give some hope that we have continued improvement in corporate earnings for the next 4 quarters. That's super important, because the only reason the stock market is up, the US market is up 20% on the year, is because earnings expectations are up 20% on the year. Those are beginning to flatten, which is why we're getting a little bit of volatility here. But in order to believe in future corporate earnings growth, you have to believe in increased demand and increased supply. If the supply is not there, the demand, as long as the economy is good, should continue to be there. And so you might get better longer term corporate earnings growth than you otherwise would if all that supply was available for sale today. So the bottom line is we view this issue as a mixed bag. We don't see it as uniformly negative. We see it as a chance to elongate the cycle while only giving some limited inflation pressure support to certain industries that really need the pricing support anyway. That's a good way to segue into the third question, which is, what does cost push inflation because of limited supply and strong demand do to Federal Reserve rate policy? And the logic here is very straightforward, and I think very important. If you have cost push inflation, inflation is rising through the supply chain and therefore will end up in the consumer, then does the Fed have to increase interest rates more quickly? 2 points on this. The first is, and this is very clear, the market says this is not going to happen. If you look at Fed funds futures right now, they give the strongest odds to no rate hike next year, 45% odds to no rate hike in 2022, followed by odds of just 1 rate hike at 38%. So as much as there is definite supply chain issues and supply chain inflation issues, Fed funds futures don't think it forces the Fed to change policy from keeping rates low for quite long. On top of that, TIPS inflation, the inflation embedded in Treasury inflation protected securities, those haven't moved at all, in 4 months. They're still at 2.2 to 2.6% for 10 and 5-year forward inflation expectations, which, when you think about all the hot CPI reports that we've gotten in the last 4 months, to us signals that that market is in concurrence with the Fed funds futures market. It says that inflation is somewhat temporary. It is transitory. And then finally, the 10-year yield at 135 also signals that inflation just isn't an issue. And as much as people talk about Fed QE and bond buying, the Fed's been in the market for the last 17 months, and these yields have settled out where they are. So we don't think it's just the Fed putting their finger on the scales. This is the market's actual viewpoint on future inflation. And the question is why? Why is the market so complacent about inflation? And 3 points on this. The first is that CPI ex gasoline and new and used cars is running 2.2%. When you take out gasoline inflation, because it was an easy comp last year, and new and used cars, because that is a structural level of inflation, but very limited, the remaining CPI is only up 2.2%, low twos, not a big worry, and right on top of where the TIPS inflation expectations are. Second point, history shows the last cycle, 2010 to 2020, had very low levels of economic growth, relatively speaking to prior cycles, and very low levels of inflation. The Fed rarely got to its 2% inflation goal. So the immediate history, which the bond market really relies on to tell us about the future, says the US economy is not structured for even medium inflation, let alone high inflation. It never occurred in the last cycle. And then lastly, and this is more of a broad macro point, populations that are old and aging don't tend to create a lot of inflation. Inflation tends to be a young demographic phenomenon as people form households and have kids and have a lot of consumption. As a population ages, it creates less inflation. We see this in Japan. We see this in Europe. And the US population right now at 38 years old is the median and rising is not a recipe for high monetary velocity, money moving through the system, and therefore inflation. So our conclusion here about supply chains affecting inflation is we're not worried about supply chains really moving inflation. However, we're worried about two things. First, housing inflation is beginning to turn. And that ran 3% all through the 2010s. If it runs 4% this time, and it easily could, we could have a structural inflation problem. The second issue is food inflation. Food inflation is really picking up in a way that I think is damaging to the Federal Reserve's credibility. Last month, for example, with the CPI data out yesterday, food inflation up 4%, protein inflation, meat, eggs, poultry up 8% year over year, on top of 4% comps last year. So there is an inflation problem, but I think it's more in housing and in food. And I think it's one reason why the Fed is going to get much more vocal about its tapering at the meeting next week and going into the end of the year. They do have to move on inflation. It is happening. It's not supply chain, though. It's housing and it's food. And then finally, my final point, and then I'll hand it over to Jessica, is there was a question about the debt ceiling negotiations and other DC issues. Basically, what could happen in Washington between now and year end that would really upset capital markets? The debt ceiling is going to be a tough negotiation. The good news, sort of, is that we've seen this, 10, 20, 30 times in the last 10, 20, 30 years. Debt negotiations are not all that new. They happen, they're contentious. Sometimes the government even shuts down. But in the end, the US Treasury has never failed to provide timely repayment of principal or coupons in its history. And I don't think it's going to start happening this year. But it will have there'll be a lot of fireworks around the topic. The issue we're more focused on, and seriously focused on, is potential changes in tax policy, because that is now being tied to the larger infrastructure package that's moving through Congress. And I'd say that there's better than even odds that we see a corporate tax increase to 25% starting next year, and incremental taxes on individuals, particularly high earning individuals that tend to own a lot of securities. And as that begins to filter through, I think that could cause some weakness in the market between now and the balance of the year, because of all the capital gains that people have experienced in the last 18 months or even 10 years, there's going to be an appetite for cashing out and rebalancing portfolios before tax law changes come into effect. And we'll see when the cutoff is, but that does tend to happen, and that is an issue. The overarching point, and the one that I want to leave you on this particular topic, is everything. We view Washington as sort of being focused on one thing right now, and that's midterm elections. And midterm elections are funny because, in general, a sitting president's party loses seats in the House during midterm elections. And they lose between 20 and 25 seats on average. And that goes back to 1948. It's a very consistent record. And right now, the Democrats control the House by just 10 seats when you include the ones that are vacant, but likely to go Democrat when they're filled. And that's not enough to offset this 25-seat loss that typically happens. And the only way history says you can short circuit that loss in seats for the president's party is to have a president with an approval rating of roughly 60%, 60. Fairly uncommon, only happened 4 or 5 times, but it is very clear that if you can get a president's approval rating that high, then there is a coattail effect on the House elections in the midterms. The problem is that President Biden's approval rating right now is 49%, not 60%. And it's never been higher than, I think, 57 or 56. So he's never achieved that 60% level. And Democrats have to find a way to get him there. That's the bottom line. Because without that, the Republicans take back the House and possibly the Senate. And history is very clear on that point. It's not a partisan conversation. The history is very clear. So that does put more complexity around Washington than I think markets perhaps appreciate, because the big infrastructure bill, the one that's attached to the tax bill, is the one that could potentially move the needle in terms of Biden's popularity. But it's going to be hard to pass, and it does come with these tax changes embedded as well. So the bottom line, at least from our perspective, is the tax code change is the one to watch. We're watching it very closely. That's the one that could create some volatility. We are expecting markets to be volatile for September and October, and then rally into the end of the year. And that's one issue that could definitely cause the volatility we're looking for. So those are my 4 points. I'm going to turn it over to Jessica now for our final point, which was basically a request to discuss the recent Chinese tech regulatory crackdown and what it means for those stocks. So Jessica, I'll turn it over to you.
Thanks, Nick. Yes, so I was asked to basically give our view on the Chinese regulatory crackdown that's impacted a number of listed names. So yes, the Chinese regulatory crackdown has weighed heavily on a slew of major Chinese public tech companies this year, including the likes of Alibaba, Tencent, Baidu, Pinduoduo. And the backdrop to this discussion is that these and many other disruptive Chinese tech companies grew very, very fast during the pandemic because they enabled life under lockdown between a slew of platforms and services, including gaming, e-commerce, food delivery, short form video, and others. So now, as a result of that, the government is systematically trying to unwind some of this growth so that they can take some control back. And this has led to a raft of new mandates and regulations over the last year, which you've probably seen in the headlines. So with that, let's just first briefly review the events that did unfold so far over the last year so that we can explore what's going on. So it all started late last year with China. Basically, Chinese regulators prevented e-commerce company Alibaba's affiliate Ant Group from going public. And then they fined and curbed the company's power earlier this year. Other efforts to rein in big tech just kept coming. So after that, China expanded its regulatory crackdown to dozens of Chinese tech companies, whether that be internet companies like Tencent, food delivery companies like Meituan, e-commerce companies like Pinduoduo, or ride-hailing apps like Didi, just to name a few. And over the summer, China implemented new restrictions and regulations on everything from gaming, private education, to fintech, and lending. And there's even been a slew of developments even just since last Friday, including the government ordering the country's largest internet platforms companies to plan how they're going to meet new gig economy guidelines, like providing contracts to workers. They also mandated Ant Group break up its app Alipay, which has over 1 billion users, and they told internet companies to unblock external website links on their apps. Now, there's a lot of moving parts, as I just explained, on the regulatory front, but all these examples are just to show that the government is trying to both reorganize its markets and curb the power of its major local tech companies. And again, the reason for this is because the pandemic led to extremely fast growth for numerous disruptive tech companies in China. And so it will take time and many more measures for the Chinese government to catch up with all that growth. Now, it's important to quickly point out that China's experience is very different from the US. So first, China has over 3 times the number of smartphone users, over 900 million, as compared to the US, allowing many more companies to grow quicker than there than here. US regulators are also primarily focused on just 4 big tech companies, while the Chinese government is targeting dozens and has the centralized power to act a lot quicker and more aggressively to get a better handle on all this growth of its innovative tech companies over the last about 1.5 years. And that's an important nuance because it does make it tougher for investors to navigate, especially as Chinese regulators remain pretty secretive about everything they have planned. So, of course, the big question here is, what do you do with all these major Chinese tech stocks like Tencent, Alibaba, and others that have just gotten crushed on all these headlines this year? And even if you don't trade these names individually, it's important to point out that they do matter because they have large weightings in both the MSCI Emerging Markets Index and the MSCI China Index. So, for example, even after being battered this year, Tencent, Alibaba, Meituan, and JD.com, so just 4 companies, still represent nearly 11% of EEM, and that's more than all but 4 countries in the index. Now, of course, the more that these stocks fall, the smaller their weightings will get and maybe mean less to EM's performance. But right now, even just Tencent and Alibaba still make up over 8% of the index. Additionally, Tencent, Alibaba, Meituan, JD.com, Pinduoduo, Baidu, and NetEase, or just 7 Chinese tech companies, still account for over 1/3 of the MSCI China Index, or MCHI. This is the ETF's major ETF symbol there. So our bottom line here is that we do remain underweight these names and even emerging markets and Chinese equities because of their large exposures to Chinese big tech. And the reason for this is due to the continued very uncertain regulatory environment there. We don't yet see an end in sight to the government's high level of scrutiny and action towards these major companies. And it's really clear that most investors and traders have little to no information edge on this front, given that Chinese shares still continue to react poorly to regulatory news. So until these names start to rally rather than sell off on these regulatory headlines, we are going to remain cautious, because that tells us these stocks just have not bottomed yet. And overall, the Chinese government just continues to show that they're still in the process of really trying to strike a better balance of power between big corporations and the general public. So with that, I'll hand it back over to Nick.
Thanks, Jessica. That actually concludes the questions that CAPIS had for us. Happy to take any questions from John or the audience.
Yes, Nick, thank you. I have two from the field. The first one speaks to, we were talking about youth trading, and the question goes as follows. Given the new increase in retail and millennial investing and their presence in the markets, how does it bode for volatility, either intraday or in the longer term?
Great. Yep. It's a great question. So two angles on that. The first is on a day-to-day basis right now, and as I said, I've been looking at the trading volumes and the trading data from Fidelity every day and seeing what people are trading and how they're trading it. On an intraday basis right now, it is clear, like in a deeply discounted popular name, pick your favorite, Apple, Google, all the way to AMC and GME and everything else, the open tends to be the low more often than not, because the market's been rising and because this group does kind of pile in over the course of the day. So at a micro level, what I see just from my own perspective is this group trades the open and the close, and they buy the open and they sell the close. And it's sort of the classic retail opens the market and institutions close it. And that's what's happening now as well. At a broader level, and actually we just wrote this up for clients last night, I think what it means is that you're not going to see this group really pile back into the market the way they did in March or in Jan of this year, unless we get a big crack, a big sell-off. They will be there. I mean, they have been there twice now when things really sell off. We had a 3%, 4% sell-off in late January. Over the course of a couple of days, they stepped back in. We had a big sell-off in March of last year. They stepped in size. That's the kind of thing that gets their attention because, and this is where the psychology is different, they view those as unique opportunities to buy at better prices, and they do step in. They do not step in on a grind down. I don't think they've stepped in so far this month, even though we're grinding lower in September. And so a down 50 basis point day does not get this group's attention. A down 100 basis point day barely registers. It needs to be like a headline crack in the market for this group to get involved again. But then they do seem to step in. So the bad news is we could grind lower for the rest of the month and into October, and they would not care. They continue to just day trade their stuff, and they would not get back in size. If we do get a big crack, they should come back in size. That's their history. And you can understand why it is it's not just a gambling mentality. It's also the mentality that the market in general doesn't do very much unless you buy it when it's really down. And perhaps cryptocurrencies have also informed this audience's perspective on how to trade, where they have a fundamental optimism, and right or wrong, it is there. But they need to see big corrections, and they need to see things really collapse or at least decline significantly before they think, okay, that's a good buying opportunity.
Okay, thank you, Nick. And I have a second question, also has to do with volatility here. The question is, the CBOE implied volatility index is trading below 20, and yet the CBOE implied correlation index is in the 40s. How can this be? Yes. And then there's a second part to the question we'll get to in a minute, but we'll take the first part.
Yeah, no, that's a great question and a great observation. So here's how we look at it. We look at both things, very regularly. We actually do a monthly piece on volatility and another monthly piece on correlations. The funny thing about correlations, we don't look at implied correlations because there is an equally sensible way of looking at it, which is near-term historical correlations. And we do it by sector. And the linkages, the reason I smiled is because that linkage that the questioner posed is exactly the right one. And it's missed by so many people. Volatility is a function of correlation. When correlation declines, say among the 11 sectors of the S&P, when correlation is 0.5, volatility is very low. And then when it climbs all at once. And volatility tends to increase because everything moves together. So in the context of the implied correlations, correct, it's a strange confluence. In the context of recent actual correlations, it's not so strange because we've seen in general fairly low sector correlations. And we just take a simple average of all 11 sectors. We've seen relatively low actual correlations over the course of the last 6 months. And that's what's created. If you look at the VIX chart year to date, every new high is lower than the previous high. And it's a trend that's continued to now. That's a function of actual correlations. And we think that's healthy. We tend to think of it as that's a pretty good thing. And the long-term average on the VIX is 19.3. We're right around those levels now. So I don't think we're absurdly low. And I don't think we're going to get to the old levels of 10, 11, 12, that we saw in the mid 2020s or 2010s for quite a while, because we still have some fundamental issues to get through. But sort of the short answer to the question is we look at the historical correlations and they do support a VIX at 19. It does make sense. And given the rotation between growth and value and cyclicals versus tech, those have been pretty healthy. And so we tend to look at that and say, okay, that makes sense. And B, it indicates a market that's working properly.
Okay, thank you, Nick. There was also another part to that question, actually 2 more parts. So I'll read them and we'll see if we haven't answered them already. The second part was, are there nonlinear correlation structures implied in these prices, or is there a distortion effect caused by the central banks? And if there is a distortion, where's the opportunity? And then he follows up with, will we see a rise of the active long volatility trader and or the active long correlation trader?
Wow, great questions. Okay. The way I think about that, the relationship between central bank policy and volatility is in order, and maybe this just goes back to my old SAC days of finding a catalyst to create an idea and a trade idea, is in order for central banks are clearly dampening volatility. If you think about what the Fed put really is, the Fed put is not a put on stock prices. It's a put on volatility. The Fed steps in when vol goes to above 40. It always does. It always will, because volatility creates uncertainty and uncertainty creates recessions. It's pretty much that linear. So the Fed is dampening volatility. They dampened it with bond buying of corporate bonds last year. That worked very well. They're still dampening it by having very accommodative monetary policy and pushing monetary stimulus into the system. And so the question is, what will shock the Fed into changing policy such that they can't control volatility? And I'd say it comes down to this inflation point that we discussed in a couple of different ways during the formal comments. It comes down to, is there structural inflation that is lurking under the surface that the Fed is surprised by and feels the need to act on sometime in 2022 in order to get ahead of the inflation narrative before they lose credibility? Everybody understands what happened in the 70s. Everybody understands what Paul Volcker had to do to create a different inflation narrative, and nobody wants to go through an 81 recession again. But the Fed will do it if it has to. That to me is the linkage between Fed policy and correlation / volatility. And it does come down to inflation. I'm not personally a big believer that the US economy can create a lot of inflation, but I'll tell you, I was shocked by the food inflation numbers on the CPI data last month, and shocked that they're continuing year over year over year. So there is a possibility that could happen, but to me, it runs through inflation, and it runs through basically inflation forcing the Fed's hand to change its stance and raise rates. Just one sidebar, which we didn't mention in DC, is obviously Chair Powell is up for renomination. Right now, the odds are like 80% that he will be renominated, but it's not a done deal. And there is a camp in the Biden administration that wants to see a more progressive Fed chair. And elections have consequences, and they figure that Democrats should have a shot at having a Fed chair. They've had one, Janet Yellen, in the last 40 years. Everyone's been a Republican. So there's going to be some pressure to change. And if it is somebody who's more dovish and inflation picks up and they don't respond, then yes, absolutely, the return of the vol trader is inevitable. Under a more likely scenario, probably not so much. Oh, and John, you're on mute.
Oh, there we go. Sorry about that. I was clicking back and forth. That pretty much concludes our questions. And in turn, that concludes the monthly CAPIS research call. Our next call will be on October 21st, featuring market policy partners. So please stay tuned. Also be on the lookout for our upcoming virtual roundtable on transition management, tentatively set for September 30th at 11 a.m. EST. Again, we'd like to thank Nick and Jessica for participating in this month's call. And on behalf of the CAPIS family, thank you all so much for watching and have a great trading day. Thank you, everyone.